It's Mike, and I've done a lot of these presentations, and I wanted to build out something that would help better describe what we're seeing with condo changes now that we're getting a lot of feedback. A lot of sellers, a lot of agents, both on the buy side and listing agents, are reaching out to me. Hey, Mike, I know you do a lot of condos, non-workable condos, first-time homebuyer products. What's going on with these Fannie Mae changes? So I did put together a booklet. You could download that in the link below or drop me a message. Happy to send that to you. Share this, by the way, with folks that you know. But this should be helpful talking about the Fannie Mae condo changes that we're seeing in 2026. So without further ado, 1 second here. Here's our slideshow I built out for specifically this. So Fannie Mae condo financing changes 2026. So things that you should know, right? Why condo financing is different. This is a big thing. I think a lot of folks should come to understand or, start to understand what's kind of going on right now. So when somebody buys a single family home, the lender primarily evaluates the bar and the property. With a condo, there's a third component, the project itself. So a borrower could have excellent credit, strong income, substantial assets, and a perfectly acceptable individual unit. And the loan can still promise because the HOA or condominium project. So keep in mind, Fannie Mae requires lenders to determine that the applicable condo satisfies their project eligibility requirements. So why they changed the rules. The 2026 changes are intended to improve the long-term financial health and sustainability of those projects while simplifying certain project requirements. So here are the big changes. Expanded waiver project review, retirement of the limited review process, which we've had for years. And quite honestly, 10 years ago was great. It's changed recently because that's not as easy as it was. A limited or streamlined review isn't truly streamlined. Retirement of 50% investor concentration limit for established projects, which is huge. Changes to Florida condo project reviews, which goes back to 2020. I have another presentation on that. Check it out if you haven't seen it. Stronger review study requirements, replacement reserve requirement increasing from 10 to 15%, which quite honestly condos generally do have anyway. Updated master insurance requirements and updated individual unit owner insurance requirements. So these changes don't all become effective on the same date. So there's, a whole timeline that I have later on in this slideshow. We'll go over that in greater detail. So small condo projects just got more interesting. For years, it was like, hey, if you got 4 units or less, we're flying. Now it's 10 units or fewer. We don't need a full questionnaire, which is great. So that's one of the most significant changes is expansion of Fannie's waiver of project review. So for 10 units or lower, we have a lot of these in the city, San Francisco, and throughout Oakland and Los Angeles as well. I know. Um, Essentially, if you're less than that, you don't really need a full condo review questionnaire, all the stuff that we generally have done for years and years and years. That could definitely simplify financing for qualifying small condo projects, which is great news, right? So a waiver doesn't mean no rules, though. Keep that in mind. It doesn't mean no holds barred, right? It doesn't mean automatic approval. It simply means the transaction may not require the full traditional review of the project. So, right, these are some things to keep in mind. The project cannot have an unavailable status in the project manager, which is something we see as lenders. Applicable property and insurance requirements still must be satisfied. Certain additional critical repair requirements also apply depending on the transaction. So, limited review is gone August 3rd. It's already passed. I meant to record this earlier, by the way, but we had a newborn, so it's hard to get this together. So forgive that. But yeah, so keep in mind, limited review, it's gone. So easy way to look at it. So why agents should care? Couple of things. Does this project qualify for a waiver? Will it require further review? Is your project already showing an issue in Fannie Mae's system? Are there insurance, reserve, repair, litigation, or assessment concerns? Those are the four things. A path that previously qualified streamlined review, right? May not. So keep in mind, and that's why it's so important to talk to your seller. If you're listing a property, if you're representing a buyer, talk to the listing agent, find out what's going on with that HOA. So investor concentration change. Before 50%. Now 50% limit for retired established projects under full review. A project having loss of rentals doesn't automatically create the same venue problem it once did. And there's ways around that, even that, candidly. Don't confuse this with pre-sale rules. So pre-sale is completely different. Retiring the investor concentration doesn't eliminate every owner occupancy or pre-sale requirement. Fannie's pre-sale requirement for applicable newly converted projects still remains. Investor concentration in an established project is a different issue than pre-sale requirements, right? So it's different. So the big financial issue, before I go on from there, if you get a PERS approval, PERS, right? If you get a full condo approval for Fannie Mae with a condo and you're working with the builder, I would suggest looking at the builder or developer doing that. It can certainly help. Find out more on that, shoot me a message. I think it's in the slides, but yeah. So the big financial picture, HOA reserves. So the HOA is responsible for maintaining significant portions of the project, right? So without adequate reserves, an unexpected repair can become a very large assessment or worse. So Fannie wants to make sure that there's not inadequate reserves. Why? Because an unfunded reserve become a $5,000 assessment, a $20,000 assessment, a $50,000 assessment, or worse. I saw one in Sausalito, California, for a good friend of mine buying there, and beautiful property. Yes, but wow, the assessment on that thing was huge. They had to back out escrow because of it. It can happen. So current full review reserve requirement, 10% of annual budget assessed income, right? So under the full review framework, the lender reviews the HOA budget for adequacy replacement reserves, but that's changing. So that's where you see the next slide. January 4th, 10% becomes 15. So the minimum replacement reserve allocation rises from 10 to 15% of the annual budget assessment income. That's a 50% increase in the minimum reserve amount required or allocated, right? So this means HOA budgets may become even bigger financing issue hanging into 2027. So those HOAs should be preparing for that. If you are part of an HOA, I would certainly make those meetings. But for most of the budgets we've seen, they've been okay. It hasn't been this. There are some underfunded projects for one reason or another, but it's important to communicate that with your HOA property manager, right? And just go to those board meetings if you're an owner. Now, reserve studies, important distinction. Fannie Mae does not simply require every condo to have a reserve study. However, a reserve study can be used when the project's budget does not satisfy Fannie's required reserve allocation. Under the new policy, when a lender uses alternative, the budget must include the highest recommended reserve allocation identified in the reserve study, and Fannie no longer permits the baseline funding for this purpose. So the enhanced reserve study requirements become mandatory for applications dated August 3rd, 2026 or later. So don't say Fannie requires a reserve study. That's too broad. That's not the statement. Better explanation is simply Fannie requires adequate project reserves. And then a qualifying reserve study may provide an alternate method, and this may come or provide stronger requirements. So special assessments still matter. So these are the questions we generally ask. Why is the assessment imposed? What work is being completed? Is the work related to safety or critical repairs, right? SP 326. Has the assessment approved? How much does each owner owe? How much has been collected? Is the HOA financially capable of completing the project? Are homeowners delinquent? Delinquency is huge, especially right now. Believe it or not, we're seeing that with condos. So delinquent HOA dues matter. So there's a 15% threshold for units 60 days or more past due, and high delinquency can signal financial stress. You don't want to be late, just like you don't want to be late on your mortgage payment, your credit card, or your auto loan, right? Very similar. Critical repairs could kill a loan. Yes, they can. Even on non-warrantable condos, just so you're aware. There are some non-warrantable loan programs, yes, that are available. However, the real question isn't, does a building need repairs? Is what are the repairs? How serious are they? And whether they've been properly addressed. Significant deferred maintenance, unsafe conditions, critical repairs, structural problems, conditions that would affect safety, soundness, right, integrity, or habitability of the property itself. So the two biggest reasons projects are ineligible: insufficient property insurance, this is a big one, making sure insurance policies are updated. Two, critical repair issues. So SB 326, I've talked about this in other presentations. Check them out if you haven't. But this is a big one. Qualifying buildings with 3 or more multifamily dwelling units. That's what it's applied to, condos, not TICs, by the way. But the requirement applies to qualifying buildings containing 3 or more multifamily dwelling units, separate APNs. So who can inspect? Structural engineer, licensed architect for applicable condo projects. The HOA must arrange a reasonably competent inspection and show that the qualifying exterior elevated elements is safe, or what that repair looks like, to simplify that sentence right there. So here's the timing. SB 326, first inspection was required January 1, every 9 years, and then it must retain reports for 2 inspection cycles. So why this could become a mortgage issue? Well, you could have failures to meet state, local inspection requirements. Among the critical repair issues that can result in eligibility, pardon. So that would be like water intrusion, dry rot, structural deterioration, unsafe balconies, right? This goes back to 2020 in Florida with the 2 condo projects there. Yes, that was a reason, but also Berkeley, 2017. A lot of people forgot about what happened out there, right? We want to make sure things are safe for our people purchasing these properties. So SB 326 versus 721. Here's the difference, in case you're wondering. SB 326 applies to qualifying common interest developments condos, places the inspection responsibility on the association. 721 addresses exterior elevated element inspections for rental buildings, and it goes under California's current health and safety code, right? So insurance is now a major condo financing issue, if you're unaware. Insurance is an issue for a lot of things these days, I'm sure as you know, in California, but 100% of the estimated replacement cost is what's required. So the master policy coverage must generally require this or more, including the common elements in residential structures. So this is important in California. Fannie also expanded the acceptable ways lenders may document sufficient coverage. So how can replacement cost be documented? Guaranteed replacement cost coverage, extended replacement cost coverage, replacement cost from the insurer, project insurance risk appraisal, and then statement from the insurer. We need to show what that looks like if there's contingency. So statement from another qualified professional with appropriate expertise. So this is intended to provide lenders with greater flexibility, right? To make sure that, hey, is this project insured? Are the people that are going to be living here going to be safe? It's important. Habitability and safety are the 2 biggest things that we'll look at with really any type of financing structure, right? So roof insurance changed. So roofs no longer have to be insured on a replacement cost basis. So Fannie Mae still requires roofs to be insured, but this is important because roof settlement provisions have created problems with previous insurance policies. And so we retired, or Fannie Mae, should I say, retired the prior requirement for project developments to carry inflation guard coverage as well. So master policy deductibles, $50,000 is the maximum allowable per unit deductible. When the master policy has a per unit deductible, right, the bar must carry an individual per unit policy. And this is Fannie Mae's requirement. And this is effective July 1, 2026 related. So when does the buyer need to get their own policy? Under updated requirements, the buyer needs an individual unit insurance policy when the master policy doesn't cover the interior or improvements. And this has been a thing we've had forever. We call it H06, right? So this is the inside dwelling policy. So the condo project manager, CPM. CPM is Fannie Mae's system for lenders to review and manage condo project information. Full reviews under lender delegated authority use CPM. Right? So that's a full review. That's what's required. So a project status in CPM could become extremely important to financing. So Fannie Mae updated CPM in June 2026, in case you're wondering. It's June 10th to be exact. There's the date right there. Improved project researches, It's a better system to match project names and addresses. It was much harder before. Trust me, fluid duplicate and no match results. We had a lot of those. A lot of duplicates, by the way. And new lender request functionality, which are condos desks here, I know, love. So the condo is Fannie approved can, though, be misleading. I alluded to this earlier with PERS approval, but condo financing is not always as simple as approved, not approved. A project that worked for one transaction doesn't mean everyone may work. So you're always going to look at project type and size, new versus established, transaction type and occupancy. There's a lot of things that we look at. Litigation, special assessments, has any come up since the last project or last unit in the project been financed? As you can imagine, litigation is still a red flag. So what's the lawsuit about? Is the HOA a plaintiff or defendant? Does it include or is it about structural or safety problems? Could the HOA face significant financial liability? Is insurance expected to cover the exposure? And could litigation affect the project's future viability? Short-term rentals and condo hotels. Now, keep this in mind that projects that operate more like hotels or residential communities can create financing problems. They can. And there are programs for this, by the way. Non-workable condos, we do them, in case you're wondering. But that's hotel-like operations, mandatory rental programs, daily or short-term characteristics for renting, centralized booking, front desk services, rental pooling, right? Wow, the differences here that could be red flags for Fannie Mae, candidly. So HOA budgets matter more than buyers realize. That's another point. Before buying a condo, don't ask how much are the HOA due. Very low HOA dues aren't always a positive. They want to show, right, often, or they can show that's not fully funded. So what does the budget look like? How much goes to reserves? Are dues artificially low? Are major repairs coming? Are assessments likely? Are owners delinquent? Those are questions to ask on any HOA. So special assessments aren't always the enemy. Proactive HOA identifies problem. They want to fix it. There you go. They're going to fund the repair. Reactive, at risk, ignores maintenance, has no reserves. Oh well on the repair costs. Oh well on safety issues, and can't obtain adequate insurance. Those are red flags for really any type of financing, I think, or any condo. So the realtor pre-offer condo check. Here are some things. If you're an agent, please, I'll get you a copy of this. Shoot me a message. But is there a special assessment? Is there another assessment we discussed? Has HOA completed required inspections? Were structural or safety issues discovered? Any major repairs planned? Is HOA involved in litigation? Are there insurance problems? Does a project allow substantial short-term rentals? Is it new construction or an established project? And can the lender review the project early? All great questions. I'd save that one for sure. Or just send me a note. I'll send you a slide deck. Or again, the booklet is a great resource for you. What buyers should request: HOA budget, master insurance policy, HOA questionnaire, your CC&Rs, your conditions, covenants, and restrictions, bylaws, recent HOA meeting minutes, special assessment documentation, structural inspection reports, SB 326 report when it's applicable, reserve information, litigation documentation, repair bids and contracts, evidence, and completed repairs. So when you find out that litigation, there's repairs that were to be done, find out if they're complete or not, when they're going to be completed. Those are all things that I think any buyer should know, or if you're an HOA, that you should know as well. So waiting until the end of escrow. This is the biggest mistake. And I really say try to do this up front for any buyer right now. We just had one that got into escrow today, but they did all the diligence. The agent did. Great agent. She did all the diligence before the offer was accepted. By doing that, it's going to be a little bit smoother on the condo side, actually a lot smoother, because we know that the condo is going to be fine. It's going to work out well for these great buyers, right? So the biggest mistake is waiting until the end of the escrow to discover that it doesn't qualify. So remember, a buyer could be approved on RIN, have excellent credit, down payment, and have their appraisal. Condo could still be your problem. That's why project review should start as early as possible. Better condo strategy: review financing, identify the project, determine the likely review method, check project eligibility, review HOA concerns, review insurance, investigate repairs and assessments, and review the borrower in the building. Do this before contingencies are removed whenever possible. It can prevent a very, very, very expensive surprise later. So what changed for the better? Not every 2026 change makes condo financing harder. Keep that in mind. I had a conversation about that last week, and it's a big point, right? But small projects, it's great. Investors, great. Florida, retirement of the mandatory PERS review, right? For new or newly converted. Insurance, additional flexibility in documenting sufficient coverage. What got tougher? Limited review, it's gone. Reserve studies, stronger requirements, yes, but reserves, yeah, I mean, 10 to 15%, that's not a huge jump. We did that anyway. Realistically, we really did. We want to make sure it's properly insured. Project condition and insurance. You want to make sure these things are properly covered. So here's your timeline. March 18th, 2026. That's when Fannie Mae issued their letter, right? The immediate was the small project waiver, investor concentration, Florida PERS, right? Insurance changes became available. July 1, that's when certain updated insurance and deductible requirements became mandatory. August 3rd, limited review requirement out. Enhanced reserve study requirements became mandatory. Full review minimum reserve is coming in January 4th, 2027. That's from 10 to 15%. Again, most of these condo projects or most of the condos, throughout the markets, throughout California and most other states, you're going to want to make sure that they're properly funded anyway, that there's adequate reserves. Bottom line for buyers, buying a condo isn't necessarily harder, but you need to know what you're buying. Don't evaluate only price, payment, location, HOA dues. Also evaluate the financial and physical health of the HOA because a healthy condo project protects both your financing and your investment. You don't want to just buy a property to have a property and not make sure it's healthy, right? Just like if you're to buy a single family home, a multi-unit, you want to make sure that the regular maintenance is really kept up. So the bottom line for realtors, condo financing become a competitive advantage. Those that understand the Fannie Mae project reviews, budgets, reserves, SB 326, these critical repairs, right? Non-warrantable financing, alternatives, it gives you a very, very strong edge, in my opinion. So when conventional financing doesn't work, that doesn't always mean the deal is dead. There are also non-warrantable, especially financing options available. They're not priced that poorly. So questions? I'm sure there's a lot. But send me the condo. Send me, what you have on it. Shoot me an email, call, text, email. I'm here to help. I really do want to help. So would love to help you every step of the way. Feel free to reach out. I'm around. That's my information. You can find me on social at mike.belfour. But really just want to say thank you for taking the time to watch this with me and really wishing you a great, great day. And yeah, here to help.